everyone, and welcome to this webinar on investing in change. I'm Aline Reichenberg Gustafsson. I'm the editor of Nordsip, and I'm really excited today to welcome a great panel of experts. And without further ado, I will start by introducing our panelists in order and also ask them a question to set the scene. We're going to talk about investing in change, and I want to understand from them what that means. What is it that they do in their organization when it comes to investing in change, and what does it represent in terms of a strategic direction, and how do they answer the concerns of their constituents when investing in change? Because investing in change sometimes might not be considered completely kosher from an ESG perspective. So let's start with you, Christopher. Christopher Dreiman, you're head of responsible investments at Länsförsäkringar. And within Länsförsäkringar's asset management department, you're integrating ESG factors in both internally managed assets and in external manager searches. You're also monitoring investments, and you're conducting active ownership activities. You have also previously had a position at the UNPRI, and you have been co-developing there the first ever global responsible investment framework for institutional investors. So can you describe a little bit more in detail your role within Länsförsäkringar, and also for you, how do you look at investing in change versus exclusions? Länsförsäkringar states on their websites that you do both exclusions, you also do inclusions of companies that are obviously doing something right, and you're also conducting active ownership. So how do you decide when to do what, and what are the priorities of your constituents?
Hello, Aline. Thank you for inviting me to the panel, and also hello to all panelists. Yes, so it's a complex question, but I'll keep it brief. So, as you stated, we apply various responsible investment strategies, both exclusion criteria and transition criteria, inclusion criteria, as well as active ownership. Historically, going back to 2015, the story wasn't as sophisticated as it is today. We, as many of our peers, especially in the Nordic, start off with primarily excluding, starting off with thermal coal, and then also introduced other exclusion-based criteria, for example, unconventional oil and gas extraction. Now in 2019, the board of Länsförsäkringar, the mutual owned insurance company in Sweden, decided on what can be translated into a climate smart vision, with an objective to, by 2030 at the latest, align our institutional portfolios with the Paris Agreement's 1.5-degree trajectory, which means that during the decade, we intend to basically lower the emissions for each individual portfolio that we manage by roughly 50%. So in order to achieve that, we can obviously apply various responsible investment strategies, but I think what we realized in our analysis, especially when we introduced new exclusion criteria, was that when we looked at the trend for individual companies, for example, a trend of CO2 emissions, we realized that some were actually progressing much better than the historical data that we often rely on in this industry, were actually presenting the companies in a fashion that was not really forward-looking, and we realized that we also need to look at different commitments and scenarios, for example, CO2 trajectories in the long term, which led to that we in 2019, alongside the climate smart vision, also introduced the first transition criteria, especially for utility companies, where we basically apply them in parallel to our exclusion criteria. So companies can either be deemed to be in transition, thereby kept in our investable universe, or be excluded because we deem them not to be in transition. And I can come back to the details later on.
Great, thank you for this very comprehensive introduction. Now let's go on to Johan Florin, your head of communications and ESG at AP7, one of the default Swedish premium pensions solution. And you have also been active at SWESIF, for example, which is a Swedish Sustainable Investment Forum, to drive the question of sustainability and what sustainability means for investors, and especially institutional investors in Sweden, in the Nordics, and probably also to inspire the rest of Europe and ultimately, hopefully, the world to make better investment decisions. You also have been very vocal in the press about the duty of investors to engage with companies and drive change, as opposed to simply stay away and exclude companies from their portfolios. Can you explain to us a little bit more about how you function at AP7, what your role is, and especially about your view and your philosophy about driving change and transition versus excluding companies?
Okay, thank you, Elin. Very nice to be here. I'm head of communication and ESG. That means that I have a small group of people working with active ownership and with reporting and communication. And when it comes to this question about engagement and divestment, I think you have to take a step back first and ask yourself, if these are means, what is the end? So you want to accomplish something, and then one of these means is a good answer to that question. And in our case, we want to contribute to real economy effects. We want to make a difference. Something should change from our activities. And I mean, there are many ways to be a sustainable investor, but in our case, the answer is clear that we almost have a duty to use our position as a big owner to make the companies develop and go through the transitions internally. So they have to change their business. And if you're an owner, you can, this is something you can do. The alternative, just, blanket divestment, basically, is more or less redefining your investment universe. And there's not even, it's very hard to even in theory see what that change at all. So in our case, it's easy. We think engagement is the way forward. Then if you want to make things a bit more complex, we are excluding companies in a blacklisting strategy, but this also we consider an engagement tool, since the purpose and the way we do it is trying to create incentives for the companies to change. So we are prepared to invest again if they sort of shape up.
Excellent, thank you, Johan. I'm going to go on now to our asset management specialists. On the investment side, we have Tom with us, Thomas Mirema. He's investment manager at Walter Scott and Partners, part of BNY Mellon Group. And he joined the firm in 2007. And before that, he has lived and worked in Taiwan, and he has been specializing in working on these kind of transition strategies for a while now. Tom, can you explain to us a little bit about your philosophy at Walter Scott, how you invest in change, and also you in particular about your strategy? How do you look at that, from a thematic perspective?
Thanks, Eileen. Yeah, I'm happy to. So, Walter Scott, the philosophy and strategy we have is common to all investments that we make. So we're equity only and we're long only. And I think defining, we have a very long-term horizon. So, we invest on average in a business for 10 years, but some businesses we own for multiple decades. And therefore, we really view it as a partnership with the companies that we're invested in on behalf of our clients. We're looking for quality growth companies. Generally, they are aligned with areas of the economy that are growing, that have that long-term sustainable future. And therefore, with that focus, I guess the vast majority of our companies, we're not buying to change, we're buying because they're great already. And in many cases, they either have limited carbon footprints or ones that are relatively, I say relatively, easy to transition over the long term. However, we do look across the spectrum. There are clearly risks and opportunities, and there are a number of companies where it isn't so easy, or they have significant transition ahead of them, and that's obviously where engagement can come in. So I'm an investor. We do bottom-up research. We believe it's very much about the companies. We invest in about 200 companies in total. I'm responsible for about 20 of them, and I've led a number of engagement efforts with companies that I'm responsible for, and of course I can talk about other ones that we've done as a firm.
Thank you, Tom. And last but not least, Andrew, you are Andrew Perry, you're head of sustainable investment at Newton Investment Management, a part of a BNY Mellon Group. And Andrew, you oversee the sustainable investment business, as well as you're communicating the firm's approach to purposeful ownership to your global client base. You joined Newton in 2019, and previously you were already in a position that was very much specialized in sustainability at another asset management firm. Can you explain to us how you look at transitions at Newton, and also develop a little bit more about your role and how you conduct sustainable investments across the firm, and what does it entail that you're communicating the firm's approach as a purposeful owner? Sorry.
That's great, thanks, Aline. And it's just very fascinating listening to everybody else as well, but having that sort of perspective on what the asset owners and the asset managers want. And I think one observation I'd make straight away is that they are coming together. I'm also an investee, a member of an investment committee of a pension fund. So I sit on Johan and Christopher's side of the table. So it's really fascinating to see how we're converging in what we want. And one thing that I'd say about sustainability is it's all about change. For me and how we think about sustainability at Newton, it's a journey into the future. As the IPCC 6 report, highlighted, we're nowhere near being at a sustainable, balanced system yet. So it is something about change. It's inherent to everything that we do. So it's not about sustaining what we have today. It's about actually creating a sustainable future. It goes back to that Brundtland report about creating balance between economic growth, social well-being, and economic and environmental health. So I think, even that was 1987, it sets a framework for how we should think about it. It's a journey into the future. And look, as an active manager, I think that's what our job is, to help navigate our clients through a world in flux, a world in change. There's these huge forces that are reshaping the world around us. Just think of the energy transition. It's literally going to shift trillions of dollars of capital allocation over the next decade and further, and touch every industry. So for me, it's just naturally the way that I think about that forward-looking viewpoint of active. Now, we're different to maybe an asset owner, where for us, divestment isn't a concept, because if I run, like Tom, a global fund, it might have 40 or 50 stocks. So by definition, we have avoided the majority of the securities in the world. So we're always making positive choices. We're always making the choices to, because we think we can add value over and above. So engagement is very core to that. We've had somebody dedicated to engagement since '99. We see it as part of the investment process to try and encourage and support change. And I think one thing that is inherent in change, you have to have a long-term time horizon. Because if you look at what through the lens of business models or even the economic models, change takes a long time to put in place and then to play out. So you can't have a short-term time horizon and be a sustainable investor, you have to have that long-term perspective, 5 years or more, and to be a patient investor, because patience is rewarded as a virtue, particularly in the sustainable space.
Excellent point, Andrew, and thank you for introducing yourself. And we will dig down now a little bit more into what it exactly means to select investments for change. But just before we do so, I wanted to welcome our audience and also welcome questions via the Q&A function. Please feel free to ask questions whenever they pop up, and we'll try to answer them whenever they're relevant. And if your question doesn't get answered during our discussion, we'll keep it for the end, where we have reserved some time to answer to Q&A. Maybe we won't have time to answer all the questions, in which case we'll do our best to come back to you later. But so yes, the session is also recorded, just so that you're aware of it, and you will have access to the recording within a few days. But now let's move into the topic straight away. And as a follow-up question to you, Andrew, when you're talking about investing in the long term, how do you go about selecting the right type of change, the right type of investments? And how do you build a credible ESG strategy without focusing only on companies that already have a high ESG score? Because obviously if there's transitioning, they might have a quite low ESG score today.
Well, I think in terms of the transitioning element of the market, I think it's one of the most important areas to focus on at the moment. You know, if you think of net zero, achieving net zero is about real world change. It's about reducing absolute emissions into the atmosphere. So having a net zero aligned portfolio isn't going to be just about owning companies that already have low emissions, maybe just by the accident of their business model. You know, asset managers but inherently have low scope 1 and 2 emissions. You know, a recruitment firm would have low scope 1 and 2. They're not actually contributing to achieving net zero. So it's actually going to be some of the most challenged businesses: steel, cement, utilities, you know, the automotive industry, that need to transition and change, and they need to make rapid and dramatic absolute reductions. Now, I find that as an investor a really fascinating area, because they have a very high, often a high ESG risk premium associated with those activities, because their assets could be stranded, they could be taxed, their business could just become obsolete. But really, actually, because there is a market inefficiency because of the risk, they potentially represent really interesting investment opportunities, because if they can actually transition and transition ahead of the inevitable imposition on them, either by the economy or regulators to transition, then they can become really very exciting investment opportunities. And I see there are 3 deltas there. There's one, the delta from engagement, to push and encourage and support change that we as investors, you know, our investor contribution. There's then the delta from the reallocation of capital into more sustainable, environmentally friendly businesses, which is how you measure it. And then finally, the lower ESG risk premium applied to those assets and revenues. And for me, that if you get those companies that can actually make the transition and that can evidence it, that's integrated into their business model, then they can be really exciting investments. And there you can see the power of engagement to support change, but also as a feedback loop to measure and monitor progress, but also to maybe signal when a company is failing to make the transition and as an opportunity to exit.
Great, excellent perspective here. I wanted to just quickly move to the asset owner side and perhaps ask Johan to quickly jump in here to see how at AP7 you prioritize high ESG score versus maximum potential change. Does an ESG score even have any meaning to you, or is it something that you would just have a look at, you know, as just a slight indication, but really what you are looking for is more of a theory of change?
The short answer is no, it doesn't have any meaning. And of course, this has to do with how we manage our assets, the strategies we have there. We have diversification is one of the fundamentals of how we invest. We are a large part of our equity portfolio is mere market exposures with more than 3,000 companies, which means that we don't sit and try to select individual companies. We actually try to avoid that. And it's a way both to diversify and to keep costs down, of course, since, I mean, we're a pension fund and the only purpose we have fundamentally is to provide as much pension as possible. So costs should be low. But if you look from an ESG perspective, I think this the transition is an opportunity. That's where we actually can do something that has meaning. So avoid, I mean, that you can sort of segment the portfolio or the global market. It's the same. And you have the leaders and you have the laggards, and in between you have some sort of, I think we call them slipstreamers in a report we published a little while ago. And if you're looking for change, clearly the middle group, the big group in the middle is where you have the potential for change. So just selecting high ESG score has a completely different purpose than to contribute to this transition, I think.
Great, and actually there's a question that goes a little bit into that direction in the Q&A section, and but I think I'm going to direct it to Christopher, because I know Christopher has been also involved into shaping like manager selection sort of process. And basically the question is from an anonymous attendee who says, there has been a lot of press recently about spurious investment restrictions relating to sustainable funds. A lot of investment managers talk about selection and engagement, but who is checking the investment team's ESG methodologies and how objective they are?
Well, so for both external funds linked to our liquid side as well as illiquid side of the portfolio, we have a set of fundamental criteria that all our managers, external managers, need to fulfill, and then also in the both selection as well as monitoring process, meaning once a contract has been signed, we evaluate both the firm-wide commitment to responsible investment, including policy, staff, ESG data, type of strategies in place, engagement practices, etc. But also ask them to showcase and prove what kind of, as both Andrew and Johan alluded to, what kind of change has actually been achieved linked to the various responsible investment strategies they apply. And also if a certain holding is identified in individual funds that is either on our restricted list or for whatever reason deemed to be of high risk, we place the individual manager on our observation list and initiate engagement activities with an objective from our end to actually change practices within the appointed managers, either investment philosophy or for that matter, engagement practices. And yes, just to conclude, external managers and their contracts can be finalized if we don't find proof that they're actually dealing with our, in this matter, then ESG concerns. And also for side letters, when we're talking about the liquid funds, such as private equity and private lending, we stipulate in our side letter with respect to manager various ESG clauses linked to both investment restrictions as well as type of incident reporting, etc.
So just as a clarification here, does it mean that sometimes if a stock is on your restricted list, but the manager is convinced that the company is changing and that they're actively engaging with that company, would that still be an exclusion criteria and that you would ask this manager to divest, or is it something that you would consider valid as long as they have proof that they're actually conducting that engagement?
No, so we'll place the manager on our observation list for 12 months, and during that time we'll ask the manager presents its reasoning, supporting data for its view on the company, and then we will look at that, and sometimes we will reject its conclusions and ask them to divest the individual stock. Sometimes we might actually change our view as well. So it's a quite pragmatic approach.
Okay, so the very important dialogue here with the manager. Okay, so thank you so much, Christopher, and Tom. If you want to jump in and tell us a little bit more about how you look at these cases when, for example, you identify a transition theme or a company where you want to be more actively involved in helping this company change. How do you motivate that, and how do you construct your investment thesis?
Yeah. So I guess in the examples, we'd probably mostly be investing in either leaders or those slipstreamers, perhaps. And really, it becomes very much a company by company process. We see a company, the utility company, that we actually think has the assets and the potential to be a leader, and therefore, improve the multiple it trades on by kind of removing that ESG overhang. The way we would encourage, or engage with those companies, or I have engaged with those companies, would be through constant dialogue with management initially. So, working with them to understand, the assets that they have, the age of those assets, how they're, the carbon footprints of those assets, etc., going through the portfolio. So initially, it's a lot of gathering of data and understanding the business. And obviously, will always be a disadvantage relative to the management who understand it in far greater depth. But ultimately, at some point, working on that engagement, understanding, and then engaging on challenging them, saying, well, why do you not accelerate your transition? So an example would be China Light and Power in Hong Kong. They have the vast majority of power supply in Hong Kong. They also have assets in China, in Australia and India, etc. Looking at their portfolio, saying, you're being excluded, or at least they were previously, on certain lists, and therefore asset owners you're restricting yourself from certain capital because of the shape of your portfolio. You have a portfolio where coal is generating a tiny amount of profits, more in terms of power mix. What is the purpose of this portfolio, and what's your plan for that part of the portfolio? And so we've engaged for many years with CLP, for example, and first understanding, and then really going asset by asset through particularly the coal portfolio, but also the gas portfolio, talking about the multiple decade future in terms of power supply, in terms of the social impact of each individual plant and the mines associated with those plants, etc., and then working with them to accelerate their transition. So that'd be a classic example for us. Really trying to build understanding, build a partnership, understand, I guess, the challenges that the individual companies face in terms of, clearly it's always more complex when you get down to how do you shut that plant down, what are the contractual terms, what does the government say to that? There's always complexity, but ultimately if you spend enough time and you can work together as partnership and you believe that company has the potential to be a leader, and that leadership being reflected in share price appreciation, hopefully over time, that's where it's worth the effort engaging for a period of multiple years to get those outcomes.
That's an interesting point about time. We have a question in the Q&A here from Joe, who's asking a follow-up question to Andrew, actually, but I think both of you could answer potentially, because actually short-term and long-term has different meanings for different people, especially in the investment business. And basically, Andrew was saying long-term horizon to drive change, but Joe's saying there are now many initiatives incentivizing change in a much shorter term, half by 2030. We don't have time. We mean business. So what do you feel, he's asking, what do you feel your role is in to encourage this fundamental short-term change? So he thinks 2030 is short-term. I think in the investment community, 2030 might actually be still long-term. What is your view relative to that? How do you qualify short to long term? Maybe Andrew.
Yeah, well, I think you have to look at it in terms of your understanding of the business case and the business model. You know, Tom was just talking about a utility. Now, utility, fixed asset formation, their assets will last 20, 30, 40 years. So you have to understand that the decisions that they're making endure for a long time. And also you have to understand the bounds to their ability to change. So you can engage with, you know, utility, and we were talking, say, about CMS in America, where they've just retired their largest coal-fired power station or plant to 15 years earlier, and we've been engaging for 5 years. Now, they can only make that change with the permission of the regulator. It's not just something they can decide to do overnight. You know, it's all utilities are, you know, have these constraints, and so it's an important part of understanding the business model. And I think that's a really important element when you're actually engaging with companies, because it's about, you know, building credibility that you understand and acknowledge the issues that they have. You understand that the business case for change that you're presenting to them, and you're understanding the perspective and the multiple levers and time horizons it takes to make change. You know, you can't just suddenly change corporate strategy because one of your shareholders pitches up and a quarter later you completely recalibrated the business. So I think you have to understand the bounds to what can be achieved. Now, some companies as well probably don't have the mindset, the reputation, or the flexibility to change. So I think we always have to understand as well the limitations of engagement. You know, in some ways we can't make a bad company a good company. That's going to be the responsibility of the management. Now, we can understand and influence the, if you like, their understanding of the issues and encourage and support change. Maybe ultimately have to push for change in management. But, you know, there are bounds to engagement as well, and we have to recognize that, particularly as active managers. I don't want engagement to become an exercise in futility if there isn't, you know, the willingness and the ability to change, because I don't want to damage the value of my client's assets.
Right. Do you make an important point about the expectations you might have when engaging and activating change? At AP7, Johan, how do you look at that? Because you also conduct active ownership campaigns, let's say, with different companies. You've had some successes that had a lot of attention, like Facebook, for example, where you've actually managed to have some results. How do you, first of all, perhaps to the question about the time horizon, how do you define your time horizon to drive that kind of change? And then what kind of expectations can you reasonably have?
Yeah, so I completely agree with Andrew that if you want to be an active owner, you have to have a long-term perspective, because there are no, you know, quick fixes or easy wins or things like that. Everybody get lucky once in a while, but if you want to do it systematically, you have to, I think the word is, you have to be a lot of patience, but also very not give up. And for example, if you use voting and shareholder resolution and things like that, being a long-term persistent owner means that even if you have a debate that with the company where you don't agree and they don't change 1 year, you can tell them, okay, see you next year, because we're going to vote next year and the year after that and the year after that. So you don't get rid of us. We are here. We are, you know, perpetual owners, more or less. And it's part of our mission and also the way we invest. We don't have exit plans in general. So, but then there's another part of this that I want to, you know, bring in, because of course, when it comes to climate change, for example, it's not enough to say that in 2050, things will be very different, and we are working towards that. But until then, we don't have anything else to say. So see you in 20 years or 30 years or whatever. That's not very convincing. So I think that if you do this with the real purpose of, you know, contributing to this transition, you have to have intermediate goals. like 2030, perhaps even 2025. And we, and I think many other investors too, are working on our ICAPs right now, Investor Climate Action Plans, prior to the COP26. And I think this is exactly what it's about. Having a long-term goal is great, but then you have to show the world, how is this? What is your expected path towards this? And then you're going to have to report on this. Very concrete actions and changes. And I think it's the same with the company. It's great if they have goals. That's a good start, 2050, etc. But it is when they have a plan. Plans are more important than scenarios in this perspective, because they're sort of telling you, this is what our plan to do looks like.
Great. And Christopher at Länsförsäkringar, how do you prioritize this kind of engagement themes? Like, do you have that? Sometimes themes can even be in conflict. I mean, climate change on one hand and the social on the other hand, sometimes they don't really go hand in hand. How do you look at it from a strategic perspective, and how do you prioritize stewardship and engagement?
Yeah, so as you're familiar with, Aline, we're a mutual-owned insurance company owned by 23 regional insurance companies across Sweden, and there we have customer representatives on the board and various committees. So the priorities, not just with regards to sustainability, but also other priorities, are also funneled through this governance model of LF. But we have, with regards to your question, prioritize 5 of the SDGs with regards to both asset management and engagement activities. Number 3 about health, 7 on renewable energy, 11 on sustainable cities, 13 on climate change, and 15 on biodiversity. And basically, when we prioritize involvement both in one-on-one engagement activity, but also through collaborative initiatives, our starting point is set from these 5 SDGs, and then also obviously weights in the portfolios, ESG risks, whether we are direct owners versus indirect owners, and then often prefer to collaborate with either the appointed managers or through collaborative initiatives. So we have that feedback mechanism through our governance model on which priorities which is set, but then obviously also on top of that conduct a portfolio review in order to really come down to a relatively short list of companies that we can also manage from a resource perspective.
Great, and listening to these themes, I wanted to follow up with you, Tom. Do you see this sort of thematic approach to identifying change as something helpful? Like, is it something that you would use to select companies that you think could be a good change candidates, and then also when it comes to actually activating that change, would you go along this sort of this sort of thematic approach, or how do you work with that?
Yeah, I think it's very helpful. I mean, we've spent a tremendous amount of time over the last number of years trying to understand what decarbonization looks like across a global system, which is clearly just phenomenally complex. When you look country by country, industry by industry, everything's going to go at different paces. But that's where we've invested the effort. I think once you try and build that understanding, and clearly it's dynamic, technology's changing, things change over time, then you can feed that into your thinking on companies. Both your thinking on where is there potential for change in the portfolio, where are the risks in the portfolio, but also where should be, I guess more excitingly, where should we be looking for opportunities in the companies that have the solutions that are going to deliver some of that change going forward. So, I guess if you have that base and it becomes quite thematic, you're looking at, okay, which technologies specifically are going to make a big difference and are going to be significant in a decade or 2 decades time. And then which companies either have them in the portfolios today, maybe have capability to work in that direction, and also looking outside of what we don't own, where those are likely to build up. So that's, I guess you could say, a thematic kind of, where we've looked at thematics or these trends that are happening and tried to feed that back into our process, both for owned and non-owned companies.
Excellent. And then when it comes to once you have activated that change, first you identify the themes and you activate the change. How do you then go about monitoring and measuring the change that is happening? Do you have enough perspective on that?
Yeah, but I guess it definitely is a challenge, and it depends on the change that you're targeting. You know, the example of a CLP where you've got very, utilities, they're very slow, but it's very clear the path. So you can see the 50-year perspective more or less, and you can show you that curve, and so you can monitor very clear, very accurately the progress towards, first step would be Paris compliant trajectory, and then we'll see where we go from there. So in that case, it's very easy to measure. Clearly, in other cases, it's far more subtle. Are you investing enough R&D into areas, sustainability solutions? So maybe, Ashinetsu Chemical, where you've got, a good portion of the business, which is, well aligned with sustainability, but it's a business which is, has got a lot of technologies which I think can help. So they're refocusing R&D efforts, but how you measure that is far more challenging. What percentage of R&D, what are the areas you're investing in? They're not going to tell you the entire R&D pipeline. So those kind of elements are, I guess, a little bit more, an ongoing conversation and something that you can see over time as the portfolio shifts and as new products are brought to the market. But generally, data availability is getting better and better all the time. We're very supportive of, TCFD and CDP, and those are helping, for the kind of measurable targets. And otherwise, I think a lot of it is that patient, ongoing conversation, waiting for evidence. If there is no evidence, challenging, is this happening? What's going on? And kind of having that ongoing challenge and discussion with the companies that we're invested in.
Great, very helpful. And perhaps Andrew, can you illustrate this process from a Newton perspective, but also maybe with an example? I'm quite curious also to hear your views a bit beyond climate change or net zero. For example, an industry that is very controversial, like the tobacco industry. We're seeing, for example, a player like Philip Morris now trying to change. Do you think that's credible? And also, how would you go about measuring that change? What would be the targets there?
It's funny you should mention Philip Morris, because I interviewed as part of a fireside chat series that we do, the head of sustainability on Monday, and so we'll be publishing that interview in the next few weeks, where we talked about that and talked about setting, in their case, very clear baselines. It's not just measuring the delta, the change, but it's also starting for showing that you're making absolute reductions. Because if you are going to transition in the tobacco industry, you have to show that you're transitioning rapidly away from tobacco. Already that 25% of their revenues come from non-tobacco related products like IQOS. So they are making a transition. They have a very clear statement, but unfortunately still a large a chunk of their revenues are in things that have a very meaningful negative consequence to the health of clients. So it's one of the more challenged areas, which you're starting from an area of harm, which they recognize and they need to transition. And I think part of the transition as well that we have to always remember is that companies, whether it's in tobacco, whether it's in the food system, there's a lot of unhealthy foods out there that we shovel down our faces, crammed full of salt and sugar and other things that aren't healthy for us. Or the energy transition is the role of government and regulation, is that we need to make sure that we have the right incentives in the system to encourage change. So for us, the way that we think about sustainability is that we define we've got 9 sustainable themes, which we define the activities like net zero, electrification, the future of food, social inclusion, areas like the circular economy, and then detailed 70 micro themes underneath, which we're mapping to the revenue activities. So that's a way of actually evidencing and showing that the company's products and services are linked directly to sustainable activities that we define. We also then look to see what the percentage of the revenues are so that we have thresholds. But also then we want to look through our quality review process in equities, the offsetting, the adverse impacts, to use the language of the SFDR and the EU, to make sure there's a balance, in businesses, and where there are challenges, that's where engagement comes in. So when we do our quality reviews of companies before purchase, we embed engagement into that review. So it's part of the investment process, and the engagement will often take place with a portfolio manager, analyst, as well as members of the RI team. So, it's about embedding it and then having minimum standards. But I think that sort of eligibility and evidencing is important, but also very much in our approach is using themes as a way of not building the portfolio to invest in the theme, but using the theme to generate where we should find ideas. And importantly, where we will find the ideas in the value chain. So take food, for example. So food goes from production to consumption. And in between, you've got not just farmers, but you've got people supporting farmers with crop protection, seeds, farming equipment, geospatial satellite technology to help optimizing planting crops. You have distribution. We have a lot of new food distributions. And then you have retailing and consumption with a big move to organic and different preferences. At different stages of the investment cycle, you're going to find the value accrues in different parts of that value chain. So it's not about just blindly buying the theme. It's understanding how the theme shapes business opportunities, influences business models, and where in the value chain that value is best accrued, to reward, long-term shareholders.
Excellent. And perhaps Johan, now that we are talking about these themes, and Christopher gave us the sort of priorities that he set with the SDGs that they've selected at Landsprojektinger. How do you prioritize the themes at AP7 at the moment? What are you going to look at most specifically going into 2022?
Well, when it comes to focus themes, we have 3 of them running parallel all the time, and there are 3 years. So we have this conviction that it's good to start something, but it's also good to end things if you want to, sort of get some kind of momentum into it. So we have right now a transition theme, and this started at the same time as we entered into the Transition Pathway Initiative steering group. So we always try to combine collecting knowledge and develop methodology, and also contribute to standard setting and engaging with the companies, of course. What the next theme will be is nobody knows yet, but without, we haven't decided, and it's always something we can never go out public before we have decided for natural reasons, but I can just sort of observe that this climate action plans that covers both investments, engagement, advocacy, and transition will be something that has consequences for years to come. I think it will be a major movement within the financial industry, and we want to be a part of it. And we think it's what has happened in the last, say, 3 to 5 years in the industry with this type of global coordination it hasn't existed before. It's a new phenomena. It's gonna give everybody much more leverage and a better voice and better effects, impact, So that's something that will be in our focus, whatever the next theme will be. This is still sort of a mega trend within our business, but also within the industry.
And following up on the measurement side of the actions and so on. So and you said also it's important to start something. It's also important to finish something. How do you define success when it comes to having invested successfully your efforts into transitioning businesses or into, you know, concluding a thematic engagement, for example?
Yeah, this is clearly an area where we need constant improvement, because we started out with things that were virtually impossible to evaluate. It was sort of, everybody was signaling their good intentions. So that's fine. That's how it used to be. That's how everybody got started. But we have to develop these metrics and methodologies and everything to be able to evaluate. And putting things into concrete plans for change is clearly one part of it. From our perspective, since we work with the home market, we think we have this opportunity to be a universal owner. So we are more interested in the overall change than what happens in one individual company. So what we're looking at is, where are norms and standards developed, and where do they get real world consequences? I think these are the most important parts. Then you have to operationalize this, of course, into numbers of indicators and things like that, if you want to make it something that you can measure. So I think we have come a long way, but we have still a long way to go.
Of course, and of course we're not yet in the world that we all want to be living in, but in terms of concretely, for example, Christopher, you engage with companies, but you also engage with managers, as you were saying earlier. You engage with managers to understand their positions better, but they also kind of force them to change sometimes. But just to give us an idea and to gauge the results of these engagements, how would you say the responses from the managers? How active are the managers at changing their positions when you request them, and or how much effort do they put into answering your questions?
Well, it's an interesting one because we're in the middle of the RFP. The request for information season on the we target both managers of liquid funds as well as illiquid funds with these requests, and it's interesting to monitor the responses from European investors, where we now have a much greater also regulatory pressure when it comes to sustainable finance and everything related to it. Versus, for example, Anglo-Saxon investors, meaning UK and North American ones, where the regulatory pressure and also the pressure from other local asset owners in North America is growing significantly, but still in an historical comparison, maybe hasn't been as great as it's been in Europe. So where we're sensing a sort of Atlantic divide at the moment between European manager versus North American based, if we generalize. Obviously there are very proactive investment managers in North America as well, but in a general sense, that's the current view.
So from your perspective, Tom, how flexible are you to change your strategy or to have a dialogue with asset owners and firms that have very strong demands in terms of sustainability and that push back on you when it comes back to investing in transitions more specifically?
Yeah, I mean, it's a very healthy and ongoing conversation. You know, we're lucky to have clients across the spectrum. So, you know, more and more who are extremely focused on these areas will absolutely challenge our positions, will challenge us and how we manage it and prove it and evidence it and all these things. And we also have clients on the other end of the spectrum who don't want to hear anything about it, to be honest. But you know, the direction of travel is very clear, and we're very happy to to customize portfolios, really the way that our clients would like to have them. So if they want to have exclusion lists, we're of course happy to accommodate that. If they want to be more nuanced in terms of sustainability agenda around their portfolios, again, we have many different examples of different clients that have asked us to tailor their portfolios towards how they want to see their assets invested. So we have that ability to be flexible in that regard, and the direction of travel feels very clear that that's more and more going to be the case. The demand is there, and many people think slightly differently about it. So we're happy to accommodate.
Makes sense. I see that it's almost time to wrap up, and I just wanted to leave our audience with an idea of what to look forward to. Perhaps since we're with you, Tom, do you have, just very quickly, a theme or something that you think is something that is a bit beyond what we've been talking now about climate change in general or net zero? What do you think will be the surprising theme, exciting things to look forward to in 2022?
In 2022, that's
or
that's
beyond.
A tough one because let's go beyond. Yeah. So, I think there's so many, and many have been repeated here. The one that, we did this mega project on decarbonisation, and you go in with various expectations of what will be the takeaways, and we know that EVs will be big, we know that electrification is going to be incredibly important. I came away surprised at how important the circular economy will be. I have to admit, a few years ago, I didn't think it would be such a big deal, but the work that my colleagues did in that area, the more we discuss it, the more that we talk about it with companies, I think that's going to be a surprisingly important area, with both on the risk side and how you manage that, but particularly on the opportunity side. So I would watch out for all things to do with circular economy.
Great. And from your perspective, Andrew, what is the one focus or one surprising theme that you think people are not paying enough attention to?
Well, I think the surprise that people will have is that in 5 years' time, the social dimension will become much more internalized into business models. We all find the S in ESG the hardest one to get, wrap our hands around, because the data is not always there, it's much more subjective. But I go back to thinking of where we were on the climate 5 years ago, where people recognized the threat and challenges of climate change, but never really thought of it as internalized into the business models. Now, the acceleration in the transition and the internalization to many business models is now very manifest. And I think we will see exactly that same evolution in the social pillar over the next 5 years. It's pretty difficult at the moment. It's hard to see it internalized, but I think it progressively will become so, because we're seeing a generational shift in boardrooms, in society, and in the investment community. And I think a lot of that can be manifested through the sort of concept of the future of work, because work is the way that there's a universal, diffuse concept. So that's my forecast, that the social pillar will be seen to be important. The
social pillar, excellent. One last word, Johan, you already told us that it was really hard to look into the future. So I'll change the question slightly in your case. I would ask you a little bit more about if you think that the European regulation tsunami that is coming and that has already started, is that helping you in your mission, or what do you think the impact will be?
I think you can look at it from a positive, optimistic perspective or from a pessimistic perspective, and it's impossible to tell which one will come true. The optimistic perspective is that this becomes a more, more of a standard, sort of sorting out, weeding out all these different types of rankings and different types of rules and regulations and things. So this will become the major stick that everybody uses to evaluate what they're doing, and that's the hopeful perspective. The pessimistic perspective is, of course, that it becomes very politicized. There's a lot of lobby group that water it down, and it becomes just some sort of compromise with a lot of reporting and no real use, and it will certainly take longer than the original timetable, I'm sure. But I will also answer the question that you had with the others, just because I was sitting and think about it. If I would pick one thing that I think will increase in importance in both 2022 and further on, it's voting. Voting has been something that has been done in a certain manner for many, many years. It has, to some extent, been combined with a sustainability perspective, but not in a big way. If you look at just the last couple of years, and in particular the Eriksson annual meeting earlier this year with the engine #1 initiative and the reactions this had, and that investors have actually started to vote against individual members on the boards, and in particular regarding climate, of course. But this is just a new direction, and this will continue, and the importance of voting and the interest in voting will be growing.
Really interesting. I think I'm going to leave the last words to Christopher. What's your view of 2022 and beyond? What do you think is the one thing that people should pay more attention to?
Well, I think Andrew actually touched upon it. As we, as investors, focus more on the transition journey of individual sectors, the just transition, meaning the social component of it, will grow in importance, not just in a local context, but also in various parts of the world. And also that, I think, as Johan alluded to, we as investors probably need to do our homework ourselves and define both short-term, medium-term, and long-term objectives, so-called smart ones, in order to be respectable towards our various stakeholders, including companies that we engage with. So, yeah, defining long-term, but also short-term smart objectives will be a key priority for the investment community.
Well, we certainly look forward to that and to reporting more on these initiatives on Nordsip. Thank you so much for being part of the panel today, Johan, Andrew, Tom, and Christopher. That was very informative. Thank you again, and I hope to see you all very soon.